This week we are talking about the case CIR versus Stockwell 1993. This case is talking about um, how to distinguish income or revenue from capital receipts in realization of shares or trading shares. So what happened in the case? Secondly, the taxpayer was a structural engineer who inherited $73,000. In 1987, the taxpayer used this money to purchase the parcels of shares between July and August 1987. The shares were held for 2 to 8 months and purchased with the intention of making a short-term gain. In August 1987, one parcel of shares was sold at a small profit and reinvested. Between October 1987 and March 1988, the taxpayers sold their entire share holding at a loss of $30,410. Big loss. So the taxpayer claimed a deduction for loss on a number of grounds, including that he was carrying on a business of share trading. Inland Revenue disallowed the deduction claim, but the CRA held that at the relevant time, the taxpayer was carried on the business of buying and selling shares, and the losses he incurred were deductible. The CIR appealed that decision, but the High Court ordered that appeal was to be determined by Court of Appeal. So this is the fact of the case. There are two legal issues. Firstly, whether taxpayer is carrying on a share trading business. And the second one is whether the loss is deductible. Now is the decision of the Court of Appeal. The Court of Appeal allowed the deduction. The dominant purpose of the taxpayer in purchasing the share was to sell them at a profit. Because the taxpayer was trading in shares, they were not capital but revenue. Cook P also observed that the courts would be slow to find that a taxpayer had earmarked a business if they only devoted their spare time to their activity. The same applied to taxpayer had engaged in modest trading in shares. In such case, the presumption will be against a business. However, the TRA had already found on their evidence a business existed, and their court did not seek to re-examine their evidence. Now, it's my comments on decision. In my opinion, the decision made in their case was very prudent and careful. On the other hand, I feel the distinction between what is capital perfect or income is very significant when it involves buying and selling shares. The guidelines provided on this matter are unclear, which had added to their confusion. In a case that related to tax issues on shares to realization, how to determine whether the taxpayer's dominant purpose in purchasing the shares was to sell them for making profit is very interesting and complicated. It's common knowledge that a share is an interest in the capital of a company. The profits or loss made on the sale or other disposal of shares is on capital account and generally not acceptable or deductible. In Commissioner of Inland Revenue, the workers to English, Cook preside ordinarily in the event of selling their shares, he or she will neither incur liability for tax or any profit, nor be entitled to deduct any loss. However, there are exceptions to the general rule if taxpayers' activities fall under any of the three laws. In Section CB5 of ITA 2007, this section is also Section 65, subsection 2E of ITA 1976, where their gains derived in their business of dealing shares, and in Section CB4, if the taxpayer acquired the property for the purpose of resale or other disposition, and in Section CB3, if the gains were derived from carrying out of any activity or scheme for the purpose of making a profit. So did the taxpayer had the dominant purpose in purchasing the shares for selling them and making profit? If taxpayers is a casual investor who buys and sells shares on the share market, is generally of the view that the only tax they have to pay is on dividends, as they did not acquire shares with the purpose to resell. So, he will claim that the dominant purpose of acquiring the shares was to generate dividend income, and buying and selling of shares was a mechanism of achieving that purpose. However, it's difficult to determine in any case where shares are purchased, in which the purchaser does not have at least some intentions of disposing of them if the value of them is high enough. So, the general theory is that if you make an investment with the intention of holding on to for the long term, the gains derived will not be taxable. However, proving a taxpayer's intention at the time of acquisition has been a difficulty and a costly exercise. The intention of the taxpayer at the time of disposal of shares is irrelevant. In the Stockwell case, the court had determined the taxpayer had dominant purpose in purchasing shares for selling them and therefore making profit. So it made the process of judicial proceedings very clear. And for another question, whether a taxpayer carrying a share trading business. Besides, the court had determined that the taxpayer had the dominant purpose for making profit. The taxpayer had also proved on a balance of the probability that in the purchase and sale of the shares, he was carrying on a business. He intended to make a profit on the share transactions. So the evidence in this case fell well short of satisfying the share dealer test. Also, the Hardy Boy stated, the buying and selling of shares is typical of many activities that may or may not be a business according to their individual circumstances, carried on merely to supplement an adequate income from other sources, or to provide interest or excitement. It is unlikely to be a business that the person may regard himself as a trader is a little assistance. One would normally expect to find a considerable number of purchases and sell over an appreciable period of time before he could be regarded as dealing in shares and a substantial capital investment before one would take the next step if regarding him as in the business of dealing the shares. It's clear from the above that the Court of Appeal in emphasized that no general test can be let wrong. However, as Hardy, Boyce Jr. mentioned that their test pair is to have a considerable number of purchases and sales over a period of time and reinvest invest in a substantial amount of capital in order to be in the business of shares dealing. So the frequency of trading could be an important factor in determining whether the taxpayer is carrying a business. What has happened to a case subsequently? In respect of losses, legislative changes incorporated into the Income Tax Act 1994 for revenue account property, following the English and Stockwell decisions, mean that if the shares are revenue account to property, the person is allowed a deduction for the cost of shares. Section DB23 applies to revenue account property and allows the taxpayer a deduction and the general deductibility provision. Although the cost of purchasing personal property is often capital in nature and is therefore prohibited from being allowable deductions. Section DB 33, subsection 3, clarifying that the cost of revenue account property is not a capital cost and overrides the capital limitation as stipulated in section DA2 subsection 1. However, the other general limitations still apply. There is no clear line between deductibility and non-deductibility, as each case depends on its own facts. A loss generated on disposal of shares can be offset against other income of the person without a restriction in their circumstances. Other associated costs such as interest and brokerage cost are allowed as a deduction. Having determined that the shares are held on revenue account, any loss is only deductible in the income years of disposal. So, which year is the income year of disposal? Pursuant to section EA2, the deduction cost of the share is allocated to the earlier of the year of disposal or the year in which the property ceases in existence. This is a timing issue designed to ensure the matching of income and deduction. However, this section does not apply if the property is trading stock dealt with in EB2. And now, CGT maybe is a good solution to resolve the problem and this topic. The CGT regime has, to a degree, reduced this uncertainty in the other jurisdictions, particularly with individual taxpayers. In seeing that, the writer of the view that the introduction of CGT regime will provide taxpayers certainty, clarity, and avoid significant litigation and economic costs. For example, taxing shares on a realized basis could be considered a method which is the norm in the rest of the OECD countries. At the same time, any losses made from sale of shares can only be used to offset against any future capital gain made from sale of the shares. So this is the case note